Thanks for joining us today. We have an interesting topic. It is an American IRA presentation on self-directed retirement accounts, but today we're going to get a little philosophical. We're going to talk about where we are in the market and a couple of ideas about how we can invest in this kind of turbulent part of the cycle. So this is three strategies to make money in your IRA or 401k right now. My name is Sean McKay, and again, this is an American IRA presentation. Excuse me. So the first thing I want to say is that the ideas that I'm going to throw out there today are just purely my ideas. We are not financial advisors, CPAs, or attorneys. So this is really just for entertainment purposes. So always speak with your tax, legal, and financial professionals before moving forward with any investment ideas. I think I'm qualified to at least share my ideas simply because first, I've been involved in the investment game for 20 years. I've made certainly a substantial amount of mistakes, and I like to kind of highlight those and share those with our client base because I think it's always helpful to learn from other investors' missteps so that hopefully you don't have to make at least those same mistakes yourself. And I've also been fortunate. My wife and I have built a pretty substantial nest egg and net worth and what have you. And so we've had some successes along the way, mostly trying to be copycats for colleagues, friends, and family that have been pretty successful in their investing journey. So with all that said, again, American IRA is just simply a provider of retirement accounts. We are a self-directed IRA administrator. And so we are certainly not in the business of suggesting opportunities to you. Again, this is just purely for entertainment purposes about just some ideas to kick around in your investment community and to analyze the pros and cons because certainly no investment is perfect. Any strategy can be profitable if you execute that well. And so today I'm really just going to focus on some things that, again, my wife and I have done over the years that have been beneficial and have worked out well. And so ultimately, we are certainly at a different phase in the market cycle, whether it's the stock market, the real estate market, really any asset class. Things are very different today as we talk to you in November of 2022 relative to what they were 12 months or 24 months ago. And so it's important just to have these discussions and to kick some ideas around. And you might disagree with all of these ideas, and that's perfectly fine as well. You see very successful individuals that have diametrically opposing ideas. And so for those of us that are just trying to move our portfolios forward, it's understandable that we can have some significant disagreement as well. And so when we look at volatile markets, as I like to say, this is kind of a gift from the investment gods. Anytime prices are softening, anytime there's any sort of regression in an asset class, that can be a tremendous opportunity for us as investors. We've certainly all heard the sayings that wealth is created in recessions, wealth is created when the value of assets go down. And so we're starting to see that happening again, really in a lot of different asset classes, where it appears to be earlier in the softening of the real estate cycle, but certainly the stock market in 2022 has been beaten up pretty good. And so ultimately, this is certainly an opportunity for us to look at what's in our strike zone. What investments do we feel like we're capable of executing on, and ideally holding on to those investments for a multitude of years so that we can see the real growth as asset classes inevitably come back in value. And so one of my financial heroes is Charlie Munger. He's kind of the right-hand man of Warren Buffett at Berkshire Hathaway. And he's always pretty candid in the way that he talks about investing and about market cycles. And his view is that in his illustrious career of probably close to 60, 70 years as an investor, he's in his 90s now, you have to accept, if you're going to be a successful long-term investor, that the assets that you hold over your career are going to be cut in half in terms of the value. So the stock that's worth $100 at some point in your long-term hold of that asset is going to be worth $50 or less, just based upon what inevitably happens with market cycles, with credit markets, with asset markets. Things happen. And so you have to be able to be strong and to hold on to those assets and not be a panic seller. And so, as they say, if you can't take the heat, get out of the kitchen. And so his view is, if you're unwilling to hold these assets when they inevitably come back in value, that perhaps you're not cut out to be the decision maker for your investment portfolio, and that should be outsourced to other individuals that ideally can have kind of a clearer head as they're looking at these markets. And so as we look at kind of what the plan is, in my very simple mind, I've kind of reduced this down to kind of two ways that we can deal with softening asset prices. And this is certainly making the assumption that we currently have some investments in our portfolio. So that could be stock market investments, individual stocks, mutual funds, index funds. Perhaps we own digital assets that have certainly been hit this year as well. Maybe we own some real estate in our portfolio. And so in my mind, we look at this and we say, okay, we can look at our investment portfolio in this down market, and we can deal with it in one of two ways. So first, we can just say, okay, we're not emotionally equipped to see the values continuously diminish in our portfolio. So we have to be that investor that just completely puts it on the shelf and we ignore it, and we spend all of our time on our career, our family life, our extracurricular activities, and we just want to essentially go into financial mental hibernation, if you will. So we're not going to look at our financial statements, et cetera. We're just going to move on with the other aspects of our life and enjoy it. Or we can look at it and say, okay, we believe we're mentally equipped to deal with the current circumstances and the barrage of bad news that we're getting on all the media outlets, but we can be really excited about the opportunity in front of us. We can have that contrarian mindset. And when everybody's getting scared, we can be enthusiastic in looking for and hunting for opportunities to add to our portfolio. And so today, what we're going to focus on is looking at opportunities that might be interesting for our portfolio and can also give us a sense that we're making progress with our portfolio. And largely that's because if done correctly, these investments can throw off positive cash flow. So even if the assets continue to deteriorate in value, we can hang our hat on the fact that it's actually producing cash flow for us, which makes us feel as though there's progress there. So the first opportunity I wanted to highlight was the idea of being a private lender. And so typically what we see from our clients is that this comes in the form of lending money to real estate investors, real estate entrepreneurs for investment projects that they need funding for. So to me, now more than ever, we need to be very cautious about the construction of these loans and making sure that we're very conservative in underwriting how we lend money. And first and foremost, that's going to come to the idea of having a low loan to value. So if a property is worth 250K, ideally we wouldn't be lending more than, let's say, 150K. And really what that does is that gives us a margin of safety, because if that 250K house comes back in value, let's say 20%, there's still margin for us and for that borrower to be able to get out of that deal, hopefully in a profitable manner. And so that's the name of the game with private lending, is we understand that there's really two outcomes. So the first outcome is that we get that agreed upon rate of return with that borrower. So the great thing about the market we're in now is interest rates are going up across the board. So it's easier and easier to charge double-digit interest rates to our borrowers, because if they go to a bank to get an investment loan, they might be at about 8% in this current market. And so charging 10 to 15% in the secondary market, this private market, is very realistic. The other opportunity for us, and kind of what gives us a tailwind as a private lender, is that in at least the Charlotte, North Carolina market, where I live, work, and invest, what we're seeing is there are fewer and fewer private lenders that are comfortable lending in this environment. Everyone is very terrified, and perhaps rightly so, that we're going to have a significant pullback. And so the money is leaving the street. And so it's a traditional supply and demand type of dilemma for these borrowers. They understand there's fewer sources and more expensive sources to draw from. And so that gives us an opportunity to make a positive investment. So again, option number one or outcome number one is we lend money, everything goes well, we make our 10 to 15% interest, we move on with our investment portfolio, we have a positive outcome for 2022 in terms of that, in this case, 150K that we put out there into the investment arena. Outcome number two is for whatever reason, the borrower can't perform, God forbid there's some sort of accident and something happens to the borrower, whatever the case may be, our retirement account would have to foreclose on that borrower, and the retirement account would actually take ownership of this asset. And so that may not be plan A, but it could be a pretty solid plan B where we've essentially acquired this property. Because again, we paid for this property with our retirement account funds. Now it owns this property free and clear. And let's take a really pessimistic view of the marketplace. And let's say that the value of that property continues to go down and down and down, and we don't feel like it makes sense to sell at this point in time. Well, now we've added a free and clear rental property to our portfolio. We can hand that off to a quality property manager, and it can create cash flow based on being a rental property that doesn't have a mortgage. And certainly in most metropolitan areas, certainly in Charlotte, the rental market is incredibly strong. The low end of our market just a few years ago was maybe $800-900 for the roughest properties in the roughest areas. That same property now is $1,200. So this property could be creating a rental value of, let's say, maybe $1,800 a month of gross rental value. So that's not a bad outcome. And then again, in the years to come, inevitably the real estate market will become healthy again, and it could be at a point where it could be very profitable to sell this property that's been owned by your retirement account, or you might decide to keep it as a long-term rental and kind of diversifying your portfolio. So that's thought number one, is private lending. Now, thought number two might surprise a lot of our clients. They understand that I'm pretty much all real estate all the time. And so as I kind of progress through my journey, and again, getting feedback from a lot more intelligent and successful investors, bit by bit, I am starting to respect the idea of a bit of diversification in the portfolio. And so again, as we talk about the stock market for 2022, it's been beaten up pretty good. There's been a lot of value lost, especially at the top end with the high flying tech stocks and growth stocks. They've really been demolished. But even amongst the kind of blue chip companies, there's been a regression in value with a lot of those companies. And so one idea that we can look at is, in an effort, again, to create a cash flow from our investments, we can look at stocks that actually produce a pretty significant dividend. And so what that does is that allows us to have an asset that may be fluctuating in terms of value, but it is producing a tangible net value in the way of cash flow. And so I think, unfortunately, for a lot of us, especially in the real estate space, we always look at the stock market as this gambling casino where you never know what stocks are going to do. And I think certainly in the short term, most of us would acknowledge we don't understand what's going to happen with the value. But there's another game we can play with the stock market, where if we have a diversified basket of stocks and an index fund, for example, which to me is an ideal idea to consider because it's a passive structure. We don't have to be reliant on some brilliant fund manager to be picking. It's kind of a structured out concept. And with that concept, that basket of usually hundreds of companies is producing cash flow. So even if AT&T cuts their dividend, for example, there's still 200, 300, 400 other companies. And out of those, inevitably others are raising their dividends. So it's kind of a net neutral situation in a lot of times. And so you're able to get this cash flow produced from this asset. And so if you just kind of put this on the shelf for that part of your portfolio, you let it compound. And then the beauty is, when prices go down in an asset class like the stock market, if you're reinvesting those dividends, you're able to buy more and more of this basket of companies at a lower valuation. Warren Buffett has this great way of thinking about assets where he says, we all understand that if socks are 50% off, socks is in what we put on our feet, if they're 50% off, everyone wants to buy those socks because that's great value. But when stocks, publicly traded companies, when they go down in value by 50%, everyone thinks it's the end of the world and the worst time to buy those stocks. When, of course, that is the best time to buy any sort of asset when it's significantly diminished from the valuations that they were being bought and sold at months or years earlier. So index funds might be something that we can consider. Now, back to the real estate game, because again, that's kind of home base for me and what I feel like I have at least a little bit of competency in. We can look at the idea of small multifamily buildings. And so for those of you that have paid close attention to kind of my view over the last few years, I have absolutely been a pretty significant net seller. My wife and I have been a net seller of small multifamily properties for our portfolio. And the reason is pretty simple. What we have found is that with small multifamilies over the last couple of years, there's been such a massive influx of investors wanting to get involved in buying these properties as kind of new investors in the real estate space that relative to even single family houses, small multifamily properties went through the roof in terms of the valuations and the price points that people were willing to pay for these assets. And so ultimately, we felt as though other people valued these properties far more than we did. And even though we're kind of long-term real estate investors and we're not a big fan of selling, some of the prices that we've been able to sell these for, it made it difficult not to harvest that equity and move it to other opportunities. And so the flip side of that is that unfortunately, so many of these small multifamily investors, again, not having much time in the real estate investing space, were buying these assets because they heard the asset class was a great opportunity and you quote unquote can't lose money buying small multifamily properties. And they either bought too many properties, they bought with bad debt, they didn't understand how to analyze the rental property. So they were buying properties that were pretty significantly net cash flow when they added the debt to the equation. And so it's put, unfortunately, a lot of small multifamily investors already in a really difficult spot. Again, apologies if you listen to my content regularly, but I constantly talk about cash reserves being the lifeblood of your real estate investing business. And there are so many people that own 2, 3, 5, 10 duplexes that have no money in cash reserves. So if an HVAC unit goes out on any of those 10, 15, 20 units, they don't have the money to fix that. Roofs go out. God forbid there's a fire in the property, which happens more than you might think. They don't have the capacity to deal with these issues. If there's vacancies, no capital reserves to deal with this. So unfortunately for those investors, what this is leading to is already in this just initial softening of the real estate market, some panic selling from those people that own duplexes, triplexes, and quads. And so the reality is this creates an opportunity for those of you that are out there that are willing and able to buy these opportunities from investors that really need an exit. And they're looking at this market and they're saying, this is probably the beginning of the softening of the market. I already can't take care of this property. I still have perhaps some equity left in it, but I have to get out of this property before things get really dire. So especially for those of you that are looking to place capital from your retirement account and make a cash acquisition of an asset, you could get a pretty solid return on your investment dollar by acquiring some of these properties. Again, if this is your inclination, you feel like you have the skill set, and this is something that you want to consider to diversify your portfolio. So that's really what we have today. Again, just some personal thoughts. This is in no way an American IRA recommendation. I am not a licensed advisor, et cetera, et cetera. This is really just entertainment discussion amongst different investors kicking around ideas. So hopefully there was some value in there for you. Definitely feel free to check out our channel on YouTube. It's American IRA LLC. We do have kind of a sister channel called The Lousy Investor, where we do kind of a deep dive into investment concepts. And again, I talk about a lot of the mistakes I made, some things that have gone well, et cetera, in our investing career and what we've seen from fellow investors in town. So really appreciate you guys joining us. If you don't have a self-directed IRA currently and you're looking to have a discussion, we'd love to be a resource for you. You can call or email us at the information provided, Sean, SEAN, at AmericanIRA.com, or the office number is 828-257-4949.